Hi there, my name is Dorothy Bunce. As a Nevada attorney, I've been helping people solve their financial problems since 1979. As we all face some unprecedented tough economic times, I want to share some secret information about how you can save your home through a process called loan modification. Today's housing crisis is a devastating blow to all of us. Who would believe that we'd be seeing whole neighborhoods decimated by the foreclosure crisis? While we all appreciate quiet neighborhoods, no one had expected it to happen this way. It's a crisis that affects everybody. For example, I bought my home here in Las Vegas in 1993, and today it's worth half of what I paid for it. So much for investing in the American dream, right? It's like a roller coaster ride, but on this one, no one's screaming in joy. The only consolation is at least we know we're not alone. Since the economic crisis, we've all heard about all kinds of magic cures to save our homes and tricks to keep the bank from foreclosure. And most of us believe them. Heck, even the government has gotten in on the act, promising help for homeowners at risk of losing their homes. But given the fact that the government helped get us into this mess, can we really trust our Uncle Sam? Well, like those weight loss cures you see on late night infomercials, loan modification is not a miracle cure. People have shelled out a lot of cash to so-called experts only to get little or nothing in terms of results. And yet, like the unicorn or the Loch Ness Monster, the myth of the loan modification persists. So before you decide whether loan modification is the answer to your financial prayers, let's look at it in close detail. Hope you have a pen handy because you might want to take some notes on this detailed information I'm about to give you. Currently, loan modification can only help you by lowering your home mortgage payment. Right now, nothing is out there to help you with loans on investment property, rental property, a vacation home, vacant land, an apartment building, or office property. Loan modification is designed to be a short-term program. Its purpose is to help those who have a temporary problem to keep their property until the hard times have passed. Loan modification is usually not a permanent solution. It's very unusual for any modification to last more than 3 years. So if you were hoping to permanently lower your monthly mortgage, the only way to do that is by refinancing or by taking some incriminating photos of your lenders at a motel with a stranger. You might be an ideal candidate for permanent loan modification if you have an adjustable mortgage that has adjusted upwards or will adjust up soon. Who knows? Under these circumstances and given the current economy, your lender might be willing to permanently modify your loan to a fixed rate and reduce your payments. But what everyone wants is what isn't available. Everyone wants to reduce the principal balance owed on their mortgage because their property values have gone down. Unfortunately, loan modifications typically do not help with that issue. It isn't effective to argue at this point to try and get a loan modification. Unless there is a government program that will pay for the loss of your home's value, your bank isn't going to help you. Although there's been some talk of the government being willing to pay financial institutions to encourage them to reduce your principal, I don't know where the government would get that kind of money. I just don't believe the government will give each of us taxpayers tens of thousands of dollars. Believe me, if there was a government office with a sign that read, "Get your $50,000 here," I'd be the first in line. And no, I wouldn't take very kindly to other people cutting in the line. In very rare cases in which mortgage companies have reduced the principal balance on a mortgage, it's happened because the mortgage company admits that they broke the law. Despite what other people or companies promising miracle loan modification may have told you, don't expect Santa Claus to be running your mortgage company and reduce your mortgage balance, or the Easter Bunny for that matter. If you're underwater with your first mortgage, that is, you owe more money on your first mortgage than your property's worth, and you have a second or even a third mortgage, there's good news. In this situation, which is all too common, your second mortgage could be seen as an unsecured debt, like a credit card or medical bill. Sure, the bank could sue you if you don't pay, but it probably won't foreclose on the property. You see, the second mortgage companies probably realize that if you lose your home in a foreclosure on your first mortgage, the second lender gets absolutely zipped. In a Chapter 13 bankruptcy, you can take advantage of a program called lien stripping. This program lets you strip off the second mortgage and completely eliminate it while paying only a small fraction of your other debts. You could also offer to settle your second mortgage by offering a lump sum to release the lien, thereby settling the debt for mere pennies on the dollar. Even if you have a third mortgage or some other kind of sub-loan that's lost value along with your property, you might even be able to lien strip or settle these loans as well. Best of all, you can tell your friends that you're a stripper. Sort of. Loan modification is not usually available for these second, third, or other subordinate property loans, like home equity lines of credit, also known by the scary sounding name of HELOCs. But in most cases, it doesn't even make sense to modify these kinds of loans. Why do that when you can eliminate them completely? Of course, you can't simply wash away all loan obligations in a Chapter 13. You still have to pay your first mortgage plus something extra based on what the bankruptcy court decides you can afford. But back to loan modification. Your mortgage company will only agree to modify your loan if it's profitable for them. And what's profitable for them in this case? Hard, green government cash. So to land that loan modification, you must apply for and qualify for the specific government program your lender participates in. Of course, your mortgage company might tack several fees on to the back end of your mortgage, making a tidy profit for them. Read your loan modification paperwork very carefully. Otherwise, you might end up having to give the bank your firstborn child. And we know what a hassle that can be. Also, be realistic about the limitations of loan modification. There's a reason suckers are attracted to loan modification, because it can be too good to be true. Loan modification is not a one-size-fits-all proposition, and there are no guarantees that you'll be successful. In some cases, there may be no way around the fact that you can't afford the loan, so there's little to do but go through the foreclosure. My advice, bite the bullet, don't whine, and get on with your life. However, if a loan modification chops your burdensome mortgage down to what might be the cost to rent a comparable location, well, it'll save you from having to move. And that's money you save on a moving truck, not to mention the cost of buying your friends pizza in order to con them into helping you. But before you decide to take the plunge into loan modification, take a realistic look at your situation. Mortgages are all about money. And unlike cheating husbands and more like the scale in the bathroom, numbers don't lie. Some of the tools you need: number 1, your current mortgage statement. 2, several recent pay stubs and other income records. 3, your tax return. 4, a loan amortization calculator. This is a program that may be included on your spreadsheet software, or you can find free ones available on the internet. 5, a regular calculator. With these tools, I want to show you how to crunch some numbers so that you can see for yourself what your mortgage payment might be with a loan modification.